Tonight on Market Call, we have David Burrows, President and Chief Investment Strategist at Barometer Capital Management. He's taking your questions on North American large caps. Hello and welcome to Market Call tonight. I'm Mark Bunting. Thanks for joining us. David Burrows is here, as mentioned. North American large caps is the topic. Here are the ways to reach us. If you have a question for Mr. Burrows, you can email us. Some of you have done that already. You can call toll free at that number that you see on your screen, or tweet us at Market Call. They all work, and we'll pass along the questions. How are you?
Great to be here.
And what did you make of this rally today, and why was it triggered? Bernanke, I guess?
Look, I think that the moment there was a whiff of higher long-term rates, you were going to get a sell-off across asset classes and correction as people did some repositioning. And I think that people are coming to the conclusion fairly quickly that just because we've had a backup in long yields doesn't mean they're going from 1.5 to 5. It may be that we're in a new range. And I think that there's been lots of Fed speak and otherwise to kind of make that clear, and his comments yesterday made that clear. So, people came out of positions and over the last few days have said, okay, where to now? And today we're back putting money back to work.
How were you positioned prior to May 22nd when we started getting a whiff of tapering?
Right. So our core mandate is a cash flow generating mandate. So we go anywhere from government debt on one end of the spectrum to dividend paying equities on the other, and try and position the portfolio for the right environment. And as we went through the early part of this year, we fairly significantly came out of debt, corporate debt and high yield debt in December and January. So we came into May with about 11% of the portfolio fixed income, all of the rest being focused in equities. If you looked at the equities camp, there were two components. One would be more interest rate sensitive, specifically yield focused. But the majority of the holdings were lower payouts, but more dividend growth to help us offset the ultimate impact of higher rates. And so if you look at the positioning from May until July, real estate investment trust became a smaller piece of the portfolio. Utilities went away. We increased financials, and we increased yield-generating energy. And so we came through May pretty well, but the portfolio looks a little bit differently than it did at the beginning of the year.
Were you among those selling during that downturn that we saw?
Well, we had taken some of the very specifically interest rate sensitive positions off prior to that. Mm-hmm. But you never get away scot-free. So for instance, we got taken out of our Bell position. TELUS remained. We reduced a bit more REIT exposure. We'd already left Canada and the REITs and moved to the U.S. Mm-hmm. for U.S. exposure. And we reduced some energy infrastructure more just because we use stops. And frankly, those are positions we've been rebuilding.
Our viewers know, David, that you like to look at stocks that are working right now, where the momentum is. What is working right now for you?
It's an interesting market. So the core theme continues to be dividend growth as a core in our portfolios, and that is a theme that continues to work. Healthcare, energy infrastructure, and so on. Having said that, with slow improvement in the housing market in the U.S. and confidence getting a little bit better, two new equity themes have become much more dominant in the last 3-4 months, and that's consumer discretionary, really focused in the U.S. domestic market, and U.S. financials, not so much Canada. In financials, life insurance companies, because they do well with rising rates, but also asset managers and some of the banks that could have rising dividends.
I noticed today that the consumer discretionary index within the S&P is up 12 straight sessions. So you're not alone in
no, listen, and at the end of the day, if you're in a good market, you better be where people want to put their money. Mm-hmm. There's no use in shying away from it. And very clearly, there are some very clear themes: pent-up demand in auto, pent-up demand in housing spending around the household, pent-up demand in apparel spending. And there's clear winners in those groups that have been doing well for a long time leading up to this point that are just continuing on now.
Mm-hmm. Okay, David, that's the table setter. We'll take a short break here, and we'll come back with questions from you for David Burrows on North American large caps.